Well, good evening and welcome to this live stream event on the 17th of November 2020. We're in pre-show mode at the moment. Thanks for spending a bit of time with us tonight. I've got the guys from Nucleus Wealth all teed up and raring to go. We've been playing with white balance and audio and all sorts of exciting things to optimize the viewer experience. So I hope it'll all work and won't fall apart. I hope you like the new little rolling globe intro, which you'll see a bit more of that ahead. We decided just to make a few changes in terms of the branding and what have you, and more about that later. Cookie likes it. That's good. Thumbs up from Cookie. Thank you very much. I appreciate that. And just to explain that I will normally be running the entire 30-minute rolling thing beforehand, but unfortunately I stuffed up tonight. And I didn't have time to correct it, so you got the static version. But never mind, you got the music, so that's the main thing. I'm just going to run this for another 30 seconds or so, and then we'll get going. And the crowd goes wild, says Siflix. Very good. Hi Otto, hi Paul, hi Butchie, James, a lot of Yogi Bear, Strategic Viewpoint, Staffer, great to see you all on. Nico, another Paul. Yeah, very interesting conversation, very interesting times to be thinking about investing and investments at the moment with everything that's going on. Okay, so that's the pre-show done. Let's get this show on the road. And Cookie wants to talk about stamp duty and abolition of stamp duty. We'll probably get to that on the way through. So hang on a sec. Let me just take that off. And then I'm just going to run that. I'll see you in a second. Well, good evening. Martin North here from Digital Finance Analytics. Thanks very much for spending some time with us tonight. Great to see you on the channel. And we've got a few more people saying, mention me, Tom, David, Theta One, Ken Tan. Look, I could go down the whole list and spend the whole show just calling out names, so I'm going to stop there for the moment. But anyway, great to have you all on board. This is a really important conversation, not least because of the tie-up that I now have with Nucleus Wealth, but because there is a really critical set of questions around financial management and investing at the moment, particularly, of course, with low interest rates and particularly with all of the other questions going on in terms of the economy and the virus and all those things. So we've got some really good people here tonight from Nucleus Wealth to help us think about some of these issues. As normal, I'm just going to remind everybody that this isn't financial advice. And if you please play nice in the chat room. No racial slurs. It's being moderated as normal. This is as at the 17th of November 2020. Use that Walk the World to get my attention, because there's always a lot of stuff going on the channel. And I've enabled Super Chat so that you can put your question right to the top. If you want to ask a question, make sure it gets seen. But also if you want to make a donation. And Ron, thanks very much for your donation already. Really appreciate it. So with that introduction, let me push a couple of buttons and see whether I can do it better than I did last week. You may remember I had Chris on last week and I got his picture to come on but forgot the sound. So I'm going to try and make sure we get both. So we'll go there and we'll go there. Right. So let's see. Damien. Oh, no, that's Tim. Hi, Tim.
Hi, Martin. How are you going?
Yeah, great. Thank you very much for spending some time with us. You all right?
I'm very well, thank you. Yes, we've spent a lot of time on white balance. I still don't think it's quite there yet, but we'll have to take it for what it is.
Believe me, it's better than it was. And Damien, are you there?
Hi, Martin. How you going?
Yay, it's working. Eureka. Okay, great to have you both on the show. Now, I thought what we should do just to start with is, one of the things I want to sort of stress to people is that Nucleus Wealth is, an entity with real people who are actually involved in making real decisions about what's going on. So maybe just a bit of introduction for both of you would be a good place to start. Damon, do you just want to give you a sort of the 30-second pen picture first?
Yeah, sure. So about the product side, is it
about you?
About me? Okay, yeah. So look, I've come from been in broking for 25 plus years. As a stockbroker, I worked in. I helped founded one of Australia's biggest independent research house, Aegis Equities Research. and ran that, and was head of research there for about 7 or 8 years. I've worked in tactical asset allocation for stockbrokers, and then I spent the last couple of years before starting Nucleus in the global quantitative team at Schroders, which was managing about 60 billion Australian dollars at the time. So so long history in terms of both markets and running money, and then I've been running Nucleus for about close to about 4 years now.
Doesn't time fly when you're enjoying yourselves, eh?
Yeah, that's right.
Tim, how about you?
Yeah, thanks, Barton. So I've had nearly 10 years now in financial advice. Prior to that, I was actually in engineering, in mining engineering game, and I had to make the move under threat of divorce back home and essentially find a new career. And I found financial advice a terrific fit, I guess, for what I like to do, which is helping people. I've worked for a number of the majors, both. I won't name names here, but some names that have featured quite heavily in Royal Commission's past. So I'm glad to have that behind me, and happy to leave, of course. And then worked in face-to-face advice for a number of years as well, putting together portfolios and really working with clients to get great outcomes. Kicked off Nucleus Wealth with Damien, of course, nearly 4 years ago. As you say, it was amazing how fast time goes. And yeah, look, really looking forward to sharing some of the work and, of course, the systems and what we have in place with your audience tonight and taking it from there, mate.
No, terrific. Well, thanks very much, and thanks both for spending some time with us. And it's just worth me emphasising to start with, I think, that I thought long and hard about positioning vis-a-vis Walk the World and DFA and what I should do. I've spoken to more than 200 people through my one-on-one sessions, which, by the way, let me just plug while I do that. This is where I talk to individuals about a particular postcode and look at the financial profile of that postcode and the property and values and those sorts of things. About an hour's conversation, pull out a lot of data and get to a lot of granularity. A lot of people were really, really enthused by that experience. But, one of the messages that came through very clearly was a broader question about investment and investment strategies. Now, I don't do financial advice. I'm not qualified to do it, and it's not within my bailiwick. But it was clear to me that there was a need to try and find an intersection point with the industry about investing and financial advice. Now, the problem is, if I'm frank, I'm quite sceptical about the financial advice industry and, frankly, the superannuation and wealth management industry generally. There's a lot of non-transparent activity goes on and a lot of fees being taken for not much benefit, in my view. But after a long sort of process of thinking and, frankly, working with Nucleus Wealth for a couple of years on the let's understand the economic environment, it's clear to me that they do understand in a similar way to me how things are actually shaping up. And given the low interest rates that we're now getting on term deposits and the fact you can't really just leave money sitting there at zero, it's time to think differently. And so that's why I've done what I've done. I haven't sort of given up on my objective, independent view of what's going on, and I will continue to do what I do on that. But it allows me then to segue the conversation to help people a little bit more and provide a different set of options within those conversation points. And the thing about Nucleus is they're, one, very transparent. Two, they've got a lot of different things going on and different options and choices. And three, you know who you're dealing with because these are the guys. So that was why I ended up doing what I'm doing. So Walk the World is now the overall sort of overarching banner, as it were, for what we do. And Walk the World, of course, is my YouTube channel. And from there, you can go to Walk the World Super and Walk the World Fund. So that's it. And they run it all. They run the ship, do it very well, I think. And essentially that's it. So I'm not selling out, but I am trying to provide an answer to a problem that's clearly a big problem based on the conversations that I've had. Now, what we want to do tonight is three things. Firstly, I want to put a bit of macro in other words, what's going on in the broader economics, and Damien's going to talk to that. Secondly, I've got some questions that people have sent through already, and we're going to try and throw those at Tim and Damien. And thirdly, we can have questions off the live stream as we go through. So that's the sort of the plan. And with that, Damien, I'm going to hand across to you because you've got some rather sporty slides to share.
Yeah. So there's sort of three different areas I wanted to run through for you, just to sort of kick it off, and I'm sure as we'll have a number of questions coming through as if past visits are any guide, but so what, and then we'll sort of jump a little bit into the investment process and how we do what we're doing, and we're going to a few performance stats and things like that. Some more practical questions that people might want to have, but. The first thing I wanted to start with was this idea. I'm not sure if anyone, a lot of you might have already seen this. This is some Ray Dalio charts, and what they're showing is the three charts at the top are showing how he sees the economy and the world sort of fitting together as a macro view, and we think there's a lot of validity to his overall view. And so the first one is productivity growth, that things gradually get better over time. We go through these short-term debt cycles, then as the next graph up and down, and finally there's this big long-term debt cycle that sort of takes much longer to play out. And so the bottom chart sort of puts all three of those into one. So you can see that sort of big long-term chart growing up above the productivity line, and then a sharp fall back, and then up you go again. But within that, there's all these other debt cycles. Now, the thing to remember is these are really long-term. So we're talking about, the long-term debt cycle is talking 50 years plus often. So the actual lengths do vary, but the issue is, and the way we've been certainly looking at this at the coronavirus was where the long-term debt cycle has been going since the 1960s, and we've seen debt increasing quite rapidly. It does look like it's getting very close to the peak. We're not sure. There were some arguments from some that last time in the 2007 was the last one, and there was a deleveraging, and I guess our view was that because governments still hadn't sort of leveraged up fully, that there was still scope for another cycle. As we sort of hit the coronavirus, one of our views was this was quite likely the end of this cycle, and we'd see it push down. What's happened though is we've seen a huge amount of government stimulus, a huge amount of central bank stimulus, and the question is, well, can we go another one? And in this short-term debt cycle, I'd argue that the peak's barely even started to roll over. Debt's hardly fallen at all, and there's a lot of focus on a lot of different central banks and governments from getting more debt out there to try and sort of push this a little bit further. And so, the question is this the big one? And, I think we're uncertain about whether it's the big one. And the longer it goes on, the more we're concerned that, the sort of some of the core things with capitalism are being changed without too much comment, which seems to say that, we can push this again for another debt cycle before we reach the big one, and we do need a final deleveraging. So, not sure if you want to talk about that first, Martin, or should I jump into the end of capitalism?
Well, let's just pick that up, because I think that's a really interesting comment that you've made there. And, there's a lot of conversations going on about long cycles. Harry Dent, of course, is somebody who's talking about that. And a number of people are saying a number of things are coming together. But the question is, which is your point, is this it, or are we going to go round the circuit once again? That really comes back to the question of, well, do we really have capitalism now or not? And, if all the central banks just go and throwing more liquidity in and just keep printing and printing and printing, how much longer can this go on for? And that seems to me to be the most critical question, but almost the most impossible question to try and deal with.
Yeah, and I guess I sort of almost... I've sort of almost put central banks to the side. I'm like, oh yeah, they're going to keep spending. There's bucket loads of money from them. And we've seen what happens in Japan. Japan's obviously kept that going for a long, long time, all funded by central banks. I guess the most interesting part for me at the moment is this next part where, the sort of this is capitalism dead part, where we know that you have these bankruptcies when people can't afford to pay their mortgage, or you've got businesses that can't meet their debts. And we've also got, if people can't pay their rent, they get evicted. We've put all those on hold initially it was for a short term. It was for a sort of 3-month period, and then it turned into a 6-month period. And now we've pretty quickly added another 6 months to it. And the question is, is there going to be another push in? So most of these are sort of varies around the globe, but there's a lot sort of expiring at the end of the year or sort of March next year. Is there enough cover from the virus to just keep pushing it out? And so I guess what I'm thinking is you might have a relatively weak economy, but within that weak economy, you've got lots of stimulus being thrown out there pretty indiscriminately. And so it does end up in the right spot more often than not, but it also ends up with people who didn't really need it as well. And so you've got this inequality growing where some people are doing quite well and really well. And so they're putting money back into whether it's the housing market, stock markets, wherever it is. And then the people that are doing badly and may have actually done really badly are either being propped up or prevented from, or sorry, not prevented, but allowed to keep trading insolvent while insolvent, or allowed to keep accruing more debts even though they might be bankrupt. And so if that's happening, you're sort of basically taking away a lot of the negatives but keeping the positives. You can see there's some, there's this whole tension, plus central banks thrown in, is how long can you keep playing this game for before you decide that you're either not a capitalist society anymore and we don't think consequences matter, or you start getting some backlash. And it could be years. So I think there's certainly some time to run before that starts becoming an issue. So I guess I sort of started a few months ago saying, no, this isn't over, because what's going to happen is central banks and governments are going to have to start suspending capitalism, and I don't think they'll go there. I think they'll gradually they'll have the view that no, we need to start bringing it back on again, and because that's the structure of our general economy. But it does appear that that's not the case, and that each step is there's less and less pushback to each push, and some of them are getting longer and longer in terms of the time to recover.
The interesting thing there is that there is no evidence, is there, that the increased money printing really has any long-term consequence other than creating more of the same. There is an argument, I think, that you could make quite strongly that in fact we've been doing the wrong things for at least a decade or two, and we haven't really seen any evidence that the strategy has been working. And of course they just say, well, we'll just throw more money at it and more money at it and more money at it. The question is, at what point does the realization hit that this is not going to work? I mean, look at Japan, look at the Eurozone. They're probably further ahead than we are. We're just following, I guess, a little naively what the Fed's been doing. I'm not sure there's a way out by just continuing to do the same again. No,
I think that's exactly right. We need a change. And it's worth noting as well that, that we've only been off the gold standard for 50 years now-ish. So it's not like this is it's basically a cycle. So if there was a structural problem in what we'd set up in the financial system, that you couldn't get that inflation and it was inherently deflationary, excluding that sort of first initial burst of energy sort of driving inflation and some debt growth, and that sort of 1970s 80s period. If there's an inherent problem with it, then we need to make changes to the system. But I don't think the political system is ready for changes yet. There's a lot of talk about making changes, but I don't think it's it hasn't exhausted all the bad options yet. So it's going to keep exhausting those bad options until there's a big enough crisis that they need to make changes.
Well, I find it fascinating that there's quite a lot of conversations about the so-called Great Reset, or they quote the IMF, or they say the digital dollar's coming and that's somehow going to magically sort of switch us to a whole new world. My issue is I'm not sure that those Great Reset strategies are actually more than just sort of vague thoughts, and I'm not sure it's necessarily going to solve anything.
No, that's right. And I think there's there's this idea as well about, look, is it universal basic incomes, or are there these other things you could start bringing in to help these. And I think it's worth going back to other times in history where you've had some rapid technological change that has just put so many people out of work that, the real job of government needs to turn into these jobs that don't return. How do we get them into different industries, rather than trying to say prop the industries that aren't doing well, prop them up for a bit longer and hope they'll come back. So so I think there's I think we could very easily get stuck in this trap of just trying to keep things the way they were, and we just need to do more of the same of what we did last time, and hope that this time we get a different result, which it doesn't seem likely.
Well, and the final point there, Damien, it seems to me that the way this works is it's the few percent who are able to sit and wait, and then when the crash happens, they sort of sweep all the assets cheap and then basically create even more wealth. So this whole process is essentially a process that creates greater divergence between the normal people and the few percent.
Yeah, well, and look, I think you can pretty safely say that that Trump being voted in is a sign that there's inherent problems in the system there, and that there's a bunch of people who aren't happy with the way it's going, and so they voted in an outsider to try and fix things. It generally happens that when you go through these problems, they saw them in the 1930s, and they voted in a bunch of people of a similar sort of populist view that they came out. They're saying they have the answers, and it's very comforting to know that people have the answers. But when they don't, that's where you start running into a lot of problems, or you get people who are really in it for their own, trying to enrich themselves and their closer allies. You can get some big political upheaval, and I think faith in politicians is certainly tapping near-time lows. I don't know if you can say all-time lows, but certainly the faith that people have within governments, and that then starts creating other issues. So I think to me there's fixing a lot of these equality issues. If they're not fixed by the people who are in power, then you're going to find that the ordinary population will keep voting for more and more extreme politicians in the hope that somebody will come up with the answer that will actually fix the problem.
Well, it's interesting you say that. Otto's just made the point, the rules of financial gravity remain. Current policies will further enrich the rich and pauperise wage slaves. They'll inevitably open up the door for a competent Trump-like popularist.
Yeah.
I think that's exactly right.
We need a benevolent dictator with charisma is what we all need, isn't it? But and it's we often use China as well in a similar vein, and in terms of how we speak about economies that have grown in a particular way, where they have this whole economy driven on the back of lots and lots of capital expenditure. And because capital expenditure was particularly low in China, sort of in the early 2000s, that was really effective, and all this money came flying in, and the economy did fantastically well. But then they started getting into the overinvestment part, but so many people have been made rich by that initial investment that it's very, very hard to change away from it. And they keep trying. For the last 10 years, they've been trying to change away from this demand-driven economy, and they just can't do it because so many people have been made rich from it who want to keep the gravy boat going. And I think Australia's got a similar problem in some of our industries, in that there's so much money being made from both property and sort of all the related sectors within that, and a lot of the finance side, that there's policies and everything's, if you wanted to try and draw away from that, so many vested interests and people with lots of money who can pay lots to the politicians of their choice will pay up in order to keep going back to those same policies until you finally, until you can't do it anymore.
Yeah. No, very true. Now, you've left the screen share on, so we haven't seen your face for a few moments. I don't know whether you've got another slide to share, or whether you want to come back. Another slide? Okay.
Let me do the last one, which is the Clash of Cultures. I'm missing an S on my title there. But I just wanted to highlight a bunch of different things, and this is probably a better one to leave up for a little while, but there's all these positive factors that are going on at the moment, whether it's government stimulus, low probability of US tax hikes. So what I mean there is Joe Biden has got a lot of US tax hikes he wants to put through, but if he doesn't get the Senate, which looks to be the probably going to be the case at the moment, is that he's going to really struggle to get those through. The earnings season was actually very good, that recently finished season. So based on all those, we're still expecting that inequality. I spoke a little bit about that before, to keep increasing. And then on the flip side, you've got all then I've got a whole bunch of these other positive factors that are sort of helping drive things. And then on the negative side, you've really got that virus exploding in the Northern Hemisphere at the moment. And we watch, in particular, I don't watch case numbers as much, or even deaths. I think the key statistic to watch is the hospitalizations, because that's where economies really start to shut down. And when people start, I guess when people are seeing on their nightly news, the hospitals are full and people are dying in hospital corridors, it doesn't matter whether there's a lockdown or not a lockdown, people are going to stop going out. And so, certainly some states in America that are still encouraging people to stay open despite this. And I think that's where, that's a key thing, sort of very short term we're looking at. And then valuations are just crazy. We have all these bankruptcies, but as I spoke about, if they keep getting delayed, how much longer can we keep zombie companies going around for? And then there's this low genuine credit growth as well. So you've got these two big sort of forces hitting each other, and then a bunch of other negative ones. But the negative ones tend to be sort of shorter term. The positive ones tend to be shorter term, and the negative ones, excluding that virus one, which is sort of very short term coming to a head, tend to be a bit longer term, and sort of maybe medium term is probably a better description for them. So you get past that first key negative factor, and there might be a little bit of clear air in terms of positive news coming out, and not a lot to stand in front of markets. And central banks that are willing to keep throwing money for the foreseeable future. Absolutely, make no mistake. This is an explicit policy. Like, this is when Governor Lowe stands up there and says he wants to encourage more risk taking. What he's saying is he wants people to get their money out of deposits and stick it somewhere else. Stick it in the economy, create jobs, hopefully create demand, get inflation going. Like, that's their plan. And so. We spoke through those factors we spoke about, saying the same policies keep getting rolled out with the same results. Is that it doesn't really work, or it works for a short period of time, but this time the boom's a little bit less than the last one, and it keeps fading down. That's the reason why people need to be serious over a longer period of time. They need to seriously consider what they're doing with their money, and whether you can leave it in those assets, because these central banks with effectively unlimited printing power, you're right in their crosshairs. You're the person they want to get out of deposits and into something else to try and drive the economy further. So.
Yeah, absolutely. And I should apologise. I took my microphone off while I was doing something I forgot to put back on, so people didn't hear the earlier question. Just to explain that we've got a private circuit between Nucleus Wealth and myself, which is working fine, but it didn't go out. So my question was, what about the 3 million who effectively are reliant on savings and now have zero returns on those savings? And you answered the question perfectly right. I think it's a big deal, and it's a big silent minority, really, in Australia, it seems to me, of people who now are really struggling to know how to make finances come together. And look, I know everyone's focusing on low mortgage rates and cheap debt and all those things, But I can also tell you that from my surveys, a lot of people who've been used to living off term deposits are very nervous about getting more involved in debt. It's just not something they want to do. So they are being cornered, frankly, by the current economic environment we're in.
Yeah, absolutely. And you know, I would hasten. I mean, look, we're a very conservative manager. Look, we only do large cap stocks sort of around the world, government bonds and cash. So I'm a bit different to others that you might see out there. But you know, I sort of feel as if my investments, or what we're trying to do with the word nucleus, is really have this core investment that you can then surround things around, but it's low risk. It's only buying the blue chip assets, and so you get the lower volatility. Some will say, oh, you need to gear up and take advantage of low interest rates and go out and buy assets if you actually want to get a decent return. But just I guess it's that whole thought that the gearing cuts both ways, and that you know, when you start gearing up, especially into investments, gearing can turn an average or a good investment, make it really good, but it can never make a bad investment good. You know, as soon as it can even turn an average investment into a poor investment. You know, so you just need to. Yeah, I'd be very worried about people who have a whole strategy of they need to take on lots and lots of debt at low interest rates and then go and invest that money with a view that that's the only way to make a decent profit on it.
Well, the whole idea of that sort of leverage model, I think, is quite concerning. But I mean, you know, the Reserve Bank governor has said on a number of occasions people have to have market exposure. It's just, you know, the nature of the beast. I would argue that they are actually driving people away from, you know, safe, secure savings into market exposure. Yep. which is a really concerning strategy in a way, and a lot of people are really uncomfortable with this.
Yeah, and so I guess the question is, so this is the question: what do you do? Are you a conscientious objector and say, well, I'll accept, but you know, I'll accept that I'm going to have to draw down on my capital and take no risk, or do you start sort of making your way further up and take some risk where possible? I think we'd certainly, we'll certainly argue that there's within a blue chip sort of portfolio that's split between cash and shares and bonds and you know, different currencies, the volatility. Obviously, the volatility is a lot higher than a term deposit where there's no volatility, but it's significantly lower than what you might find in the market. So we can sort of see that, you know, over various periods, you know, our volatility and volatility of similar funds as well, but you know, we're not the only one out there, are at least you know, a third lower than what the market and quite often as low as a half the volatility you might see in the market. You know, I think certainly we've tried to line our portfolio up so that we don't, if we can hang with the market on the way up, we're pretty happy, or even if we're slightly behind, as long as the markets are falling, we're outperforming on that perspective, with the view that, you know, protecting that capital is pretty key to the whole equation. But it's not a you know, it's nothing we can, you know, you can get a guarantee from anyone. But you know, I think it's, for us anyway, if it's a core part of your money that you want to invest, you want to be able to sleep at night knowing that that's not going to evaporate. Around that, if you want to play around that with bitcoins or gold or you know, leveraged investments or small caps, yeah, go for it. Like, that's sort of, you know, the idea is you do want to have your core of your wealth though in assets that you think are safe, secure, and you know, you can see what's there and liquid as well. You know, that's the other. You know, I think a lot of Australians in particular like to go back to houses when things go wrong and think of that as a very low risk asset. The problem is it's not an asset you can trade in and out of, and it is very liquid. So when the proverbial hits the fan, it is very, very hard to get out of houses at a reasonable price. And you know, if it gets to the stage where, you know, you've lost your job or other rates are really low and you need to start funding yourself by selling a house or things like that, it can be problematic because they're just not liquid assets. And there's other, you know, lots of other assets out there as well that are of a similar ilk. They look fine in the good times, but when things turn bad, you just can't get the money out of them. And that's where, you know, find out part of your money in that, but you want to make sure that you've got liquidity that if you need the money, you can sell things and get the money quite quickly.
Yeah, very interesting. Now, one question which came up beforehand, this is a one submitted. Nick asked, what's the difference between investing and trading? I mean, is it a fundamentally different philosophy, or is it graded between the two?
It's certainly graded between the two, but I think there's I like to think of it as the trading side is a bit like going to a restaurant because you can see lots of people there. And the idea is that works quite often, and you can try and chase around and beat. I want to be the first person into the new, pushing the trend. Every now and again, you get it completely wrong, and there's health issues, and there's other problems, or it's not even food that you like. You've lined up for an hour because there's lots of other people, but you don't actually like that food. Whereas I think the investment side is actually trying to put some research into it. Find out the food scores. Do they actually have cleanliness? Where's the chef from? Is he trained? All these types of things that might actually give you a much better idea as to whether you should be eating or shouldn't be eating at that restaurant. So I find the trading side also it's probably better than gambling. I think in terms of your odds, the odds are sort of in your favour. But the odds are certainly much more in the favour of the house in terms of the person that's taking the money to do your trades wants to encourage you to trade more, because that's their job. If it's a stockbroker or an online broker or whatever, it's their job to try and get you to churn the portfolio over. There's tax issues and other factors that sort of come into this that may mean that trading and time is the other thing. Sorry, and so the trading is I'd be worried if somebody thought they could quit their job and go out there and compete with multi-billion-dollar hedge funds who have tens of millions of dollars just to throw at research and computers that sit right next to the trade computer so they can get in faster. And that somebody is thinking, well, I can quit my job and at home I can just trade in and out and do a better job.
Yeah, there are a few people who claim that they can make more by trading Bitcoin or whatever. I have to say, good luck with that. I'm afraid that it's not where I'd go, but each their own, I guess. But what I'm interested in is that sort of segment of the population who are a little more risk averse, concerned with the economic environment that we're in, conscious of very low interest rates, and trying to find a way to preserve current wealth, but also perhaps create more wealth for the future. I mean, that to me is precisely the sort of profile of people that I think what we've done actually would align to quite well.
Yeah. Look, I think we're certainly trying. That's the market we're trying to get to, and part of the one of our core groups we're trying to get to as well is the people who. Well, we're happy to obviously have people with high balances, but there's this gap now as the Royal Commission's been pushing financial planners out of the industry that is opening up in this mid-market. It's probably sub $500,000, where the amount of compliance that a financial planner needs to do a full financial plan with everything in it means that it actually becomes cost prohibitive. And so what we're trying to do with our scaled advice, and by including Tim and blogging and podcasting and giving full transparency into everything we do, is try and bridge that gap for people in the middle, that we can give enough transparency that people can see what we're up to. If they want to invest in other assets, they can invest around it. And enough to give them that trust that they can see what we're doing and why we're doing it, so that if they don't agree, they can pull their money out. It's not a matter of finding out that 6 months later that, hey, my superannuation fund was invested in a whole bunch of airports and all these unlisted assets, and I didn't know about it, and they eventually blew up or couldn't get the money out or whatever it is. Our whole idea is that transparency side to us is extremely important in terms of giving that to people so that they can hopefully develop some more trust within what's happening.
Yeah, and I want to just touch a bit further on this sort of channeling of advice, right? Because one of the things that I think is really important for people to understand is there are multiple channels of advice available through the through the Nucleus offer. Tim, I don't know whether that's something you probably, as head of advice, presumably you've got a perspective. Yeah.
Thanks, Martin. Yeah, certainly well in my wheelhouse. We've got some slides actually just to sort of run through on this one. Maybe I'll just give Damien, in a moment. I'm not sure if you can share and I can talk, but anyway. So essentially, the way that we approach the advice process is kind of like a triage method in a way. So there's three different pathways. The first one allows people who don't want advice and they've done their own work and homework on our portfolios, and they just like to build their own blend or effectively, make a start on something and be comfortable with that and make their choice. The middle one is limited advice. And then the final one is full advice. Full advice just effectively means that we need to potentially make a referral to an external party. And we use a nationwide panel of advisors that we can make a referral to, obviously on a non-commercial basis. So the limited advice one, the middle path, is the interesting one. So 9 times out of 10, I actually recommend people to try it out. It does give you free and instant advice by working through that. It's essentially what they call a risk profiling tool, very common in the investment advice landscape. And what that does then is it gives us the ability to effectively make a recommendation on what we feel is an appropriate blend of what we do here with our portfolios. So it covers off on things like your previous investment experience, how comfortable you are with volatility, and of course time frame for investment as well, which is a crucial component in getting those risk levels right. One thing as well, of course, is we don't do any product comparison at all here at Nucleus, because obviously we certainly feel that is would be seen as conflicted, and we wouldn't be comfortable with that. And so that's where, if people are looking for a product comparison as opposed to just coming in and having a look at what we can do for them, we'll make a referral out to a third-party independent advisor to make a decision on what's appropriate for them. Jumping through now to the next one there, Damien, if you could. Mate, yep, there we go. So when going through the limited advice path, effectively, when I said before that we can do a blending, that's exactly what we do. So we've got 3 different portfolios, a high growth one, which is called tactical growth, and then 2 quite conservative ones, one with a growth focus and the other one with an income focus called tactical accumulation and income. And by going through the risk profile and asking questions about things like if you prefer or need income over growth, we're then actually able to blend for you a mixture of these 3 portfolios that all largely hold the same assets, but obviously just in different weightings. And it's quite a unique way that we can actually really zero in on getting the risk levels right in each client's portfolio on a client by client level.
Yeah, great. Okay, let me just come back to that, because I've got a couple of questions that are linked to that. a few people are saying, yeah, it sounds a bit sort of salesy, but we're just trying to provide people with a little bit of context here, right? So the first thing is this idea of there are some people out there who want a mechanism to direct their own decisions quickly and effectively into the market and see the results. So that's covered off. There are some people who want a bit of advice, a bit of information to help steer it, but there are also people who need much more specific advice. And frankly, finding a financial advisor is very complicated. So you mentioned the panel there. What screening process do you use in terms of who effectively gets referred to an advisor and which advisor? Is there a mechanism that you use? How does that work?
Yeah, great question. So look, the way that we approach that is effectively when you select either of the 3 options, we then highlight effectively, or you need to check boxes to go any further on actually making sure that this option, you're aware of, I guess, its limitations in a way, and that there are other options available. So in say for the limited advice, which is a very common one, probably 60% plus or more of our clients that come through online actually come in under advice. So it's obviously very important for people to know that somebody else has had a look at it and been able to recommend something. But it's very clear on saying things like we're not going to consider things like retirement planning. We're not going to consider insurance advice. We're not going to consider retirement planning, estate planning and things like that as well. And so it's not just saying, okay, let's just go ahead. It's about saying, well, look, these are other areas that you might want to think about. And if so, we're very mindful of the fact that the online method is not going to be able to satisfy, or do that job properly. And so it's essentially then we can move across and move into that full advice space. And as I mentioned, panel nationwide independent advisors there. I've met a lot of them. They're great guys, well respected in the industry, and we've got no problems referring our clients are there and knowing that they'll be looked after.
And I think it's worth knowing as well, Martin, there's a lot of, you spoke before about conflicts in the industry. So the ones we're dealing with are the advisors who don't get paid from products. They all have, they're all independent. So they only get paid from the money that people actually pay them. So you don't have to worry about the sort of backhanders or things happening in the background that you've been put into products because that was the one that paid the highest fee. There's no money exchanges hands between us or any of the advisors. There's no, we provided it a completely arm's length. And as Tim was saying before, this idea of no product comparison is where everyone runs into trouble in the Royal Commission, and why the banks have all been, or were initially selling their financial advice arms. Because if you turn up to CBA and say, should I sell my A&P policy and give it to you? Of course the CBA says yes, because he's going to get a commission on it. Whereas what we've come is saying, well, we don't think we can do that. So if you want a comparison between our product and somebody else's, we'll give you a referral to an independent person. We're not taking any commissions. It's all at arm's length. But if you come to us and say, yeah, okay, I've chosen to go with you, we'll definitely give you advice about which of our products is the right for your risk profile and what suits from an investment perspective, and a little bit around the structures. We can sort of point you in the right direction. But what we're not doing is coming out to people and saying, yes, we will. We'll end up with conflicted advice where we're telling people to get out of one product and into our product, which obviously pays us more money than somebody else's product.
Yeah, fair enough. You've also left the screen share on, so I'm not sure whether you want to continue to talk to slides or whether you want to come back to your hey, there you go.
Yes.
One of the other questions that we got beforehand was, you've got this sort of ethical screen and you've got this sort of preference structure that you can sort of, I don't want banks or I do want banks and those sorts of things. I guess the question is that based on sort of individual preference, or is there some other rationale as to why you might go X rather than Y? I'm just trying to understand what the context would be for using that sort of selection process.
Yeah, so the idea behind this is we really wanted to give personalisation. And I was just looking at, I was talking to Tim a little bit earlier today, and we had a slide up from a competitor who was sort of showing that they had their unit trusts that managed funds, traditional managed funds. They had some listed investment companies, and then they had their managed accounts that the high net worth people would come to these managed accounts. And so that was what it was like when you're at a big stockbroker. Somebody will turn up and say, I've got $1 million to invest, and they'll say, yeah, throw it in the managed fund. Oh, sorry, a big fund manager. Throw it in the managed fund with everyone else, and your tax positions get mixed up, and there's a few other issues within the managed fund structure, but and you might end up paying slightly higher fees. And then the bigger accounts though can turn up and say, no, I don't want to go in the trust with everyone else. I want a separately managed account. I want one that's just in my name. I don't have to worry about other people's trading issues. I don't have to worry about other people's tax issues. And if I want to be able to say, I don't want any tobacco within that fund, then that can be run without tobacco. Whereas in the managed fund itself, everyone gets the same. There's no picking and choosing. And the benefit of these, and so high net worth individuals and family offices have been using these managed accounts for 20, 30 years. But what's been happening is the fees have been coming down. And there's a number of players out there sort of trying to push technologically push these down. And they're at the stage now where we basically decided, look, we can actually run the portfolios the same way the high net worths get it. And we don't need to put, $200 million into these accounts or $100 million into these accounts to make it work. We can do it with $50,000 or $10,000. And so the idea was that what we then wanted to put was, ethical choices. They're not black and white. And everyone's got a different view. Martin, you might quite reasonably think that smoking is terrible and addictive. And Tim thinks that, but you think gambling's fine because it's somebody's choice. And Tim thinks exactly the opposite. And so rather than us making sort of ethical decisions on behalf of customers, we want them to actually sort of tick the box and take those stocks out of the portfolio themselves. So if they feel strongly about a particular, whether it be, we've got 30 something odd screens on there, whether it be from, women on boards to climate change to nuclear power, those types of factors we put back in the hands of the investors who could make that decision about, is this an ethical product in their mind or not? And do they want to make money from companies that are involved in that process?
Yeah, absolutely on that. Now, the other question that has come up a few times is transparency. Now, of course, it's a digital platform, so people can go in and pretty much see where things are pretty much all the time. And having looked around the market quite a lot, the level of transparency that you guys are actually exposing yourself to is pretty remarkable, frankly.
Thanks. Yeah, it's uncomfortable transparency, as I say. It's the stage where you get to see our mistakes as well as our as well as our wins. So I was just going to show. I had a few charts. So on every stock that's in the portfolio, we have a 2-page sort of profile that sort of goes into why is it in there, what do we think about its business model and what's different about it, and the idea is that it's not this isn't an historical factor. It's not about saying what happened in the past. It's about actually saying what's going to happen. What do we think is going to happen next year, and what is the reason for this being within it. We break down the settings as well to have your cash and actually, Tim, do you want to go through these ones? That might be a good question for you, actually.
Yeah, sure. So we've got a terrific client dashboard that is available for all of our clients, obviously invested, and we also have some. I've got some sample videos if anyone likes to reach out. Always happy to share those as well. It's available on our YouTube channel. Look, a terrific amount of insight, and look, this is part of, I guess, my experience in dealing with client portfolios and wanting this sort of information, to share with your clients and having it in a digital format for them to see anytime they like. A lot of, I guess, the unknown is taken away by having a lot of information about, say, whether or not you're underweight or overweight certain areas. And we've been able to provide this in such a way where effectively we can do it on a sector level. So at any time you can see your exposures to various sectors in the market, country level as well, and then drill right down, as Damien showed before, into an individual stock analyst report, which is actually a cut down version of what our investment teams use. So, it's good quality, and that's always available for any holding in your portfolio as well.
Okay, that's good to see. One other question that's just come in, whether you want to answer this or not, what was the performance like over the last 3 years? So, any thoughts?
That sounds like a Dorothy Dixon, somebody who knows us. Yeah, look, performance. We don't want to pitch ourselves too much on performance because performance can come and go. And I think we've got the structure. We think we've got the structure right. We've got certainly the transparency in telling people how we're positioned, why we're positioned that way. So if we look at other super funds, so our tactical growth is in the top 10 there's hundreds of these different funds out there. This is, I think we're number 3 over the last year. And actually some of the number 1 was actually limited. It's not actually a public offer fund. We're certainly up there in terms of performance. Our international one is similar. Our growth and our income and accumulation aren't top 10, but they're certainly very much into the top quartile. So so 3 years has been very good, with the big disclaimer that past performance isn't future performance. While we certainly hope we're doing our best to get there, and we're certainly being as open as we can as to what we're doing, it's not a guarantee of future performance.
No, particularly now with, of course, all of the vagaries that we discussed earlier, right, in terms of the way that the economies around the world are going and the virus and all of those things. I guess time will tell, but the point is it's transparent, so people can actually see where things are going, and that if you compare that with a lot of other funds, and I've had the unfortunate experience of trying to understand the fees and structures and in a lot of other funds, it's impossible to know. You just don't know what's going on. So this is a degree of transparency which is pretty impressive, I think, personally.
Yeah, and we do try. The fees is a good example. Thing where we try and keep a flat fee across every asset class, because the thing is we don't want you to worry that. Arguably, what we should do is charge more for international, a little bit less for Aussie, and less for bonds. Whereas what we've decided to do is flatten it out. So that you don't have to worry, well, these guys are buying lots of international. Is that because they collect a higher fee on that? Or is it because they really believe international is going to go well? And we run, Tim went through hundreds of different PDSs from all our competitors to try and put through a bit of a, because part of our onboarding process, we'll show you what sits in the PDS. And a lot of them just have these really wide ranges. They could charge from very low fees to extremely high fees, but there's no say about which one it will be. If they decide they want to buy a bunch of hedge funds because they've decided that, then you might actually end up with a lot higher fees one year than the next year. So,
no, that's a good point too. Tim, there's one for you here, which again came in beforehand. The question basically was around, look, this is very much digitally enabled, right? What about people who are less comfortable with online tools and digital enablement? Is there another way of engaging, which more traditionally as well?
Yeah, look, that's a terrific question, Martin. Look, I guess the primary way is for people to get on board is certainly online. Now, I'd like to think through the 600, 700 odd clients that have come through, we've sort of run the gamut of all people that have been comfortable in getting there. Now, that being said, look, one of the beauties of our model, and this is sort of where we're trying to meet in the middle in between the pure digital space and then obviously the high cost face-to-face advice options in the market, is the ability for us to actually pick up the phone. There's a human touch. And so for mine, look, if someone was to head over to walktheworld.com, walktheworld.nucleuswealth.com, which is the portal, walktheworld.com is obviously .com.au is your page. They made a bit of a start and they just felt a bit flummoxed or something like that, then of course the first thing you need to do is just pick up the phone or send us an email to contact@nucleuswealth.com, with the idea being that we can step you through there at a time that's suitable for yourself. The online piece obviously is fantastic for people that love using technology and are comfortable with technology, but I guess at the end of the day, not everyone's like that, and so we need to meet in the middle on that one.
Yeah, and we do have people pop in from time to time into the office, and when we're allowed in the office, I guess we're allowed back in now. We're in Melbourne, so but we do a long time ago in a galaxy far away when we were allowed to travel around the country, we did some seminars on a regular basis in most capital cities so that people could actually see us and come and ask questions and spend more. If they needed to spend more time, they can spend more time.
Right. No, that's good. And then the other question, which again beforehand, perception is not just Australia, right? You actually have reach into various international domains as part of your portfolio.
Absolutely, that's that's key to us. That especially because we've limited ourselves to large capitalisation stocks, and really within Australia, there's somewhere between 50 and 100 of those, depending upon how you want to measure it. But so you really do need to get exposure to other countries offshore, and we see that the Australian economy is dominated by banks and resources to an extent you just don't see elsewhere. And so if you go through your day and work out what car are you driving and what toothpaste are you using and shampoo you're using and all those types of things, very few of those happen to be listed in Australia, and there's often a reason to be putting those in your portfolio and just getting that much broader reach of what's available.
So how does that then square up with exchange rate risk? How do you deal with that?
Yeah, look, we take into account the exchange rate risk as we're investing. What is very handy as an Australian investor that you don't get elsewhere is that the Australian dollar is treated as a bit of a supercharged play on the world economy. And so what that means is when we hit times of trouble like we did earlier this year, and the Aussie dollar fell dramatically from whatever 70 odd cents down to 55, it actually acts as a cushioner on your international shares. So the Aussie dollar fell 20%, international shares fell say 30%. Well, you're only down 10, and then as the market, the thing is, it works the opposite direction on the way back up. So as the market rose quite dramatically and the Aussie dollar did as well, then you're giving up those gains. But what it does mean is that it can give you that real shock absorber effect. So while a lot of the research you'll see come out of say places like the US or Europe, when they talk about investment risk and the risk of buying international shares, doesn't actually work the same way for Australian investors. And so we look upon it at certain times of the cycle as being a great way of being able to have a bit of an each way bet on economies with a bit of cushion if things do go wrong.
Very interesting on that as well. And the question, of course, about the Aussie dollar is, is it going to go higher? It's 73 now, or is it going to go lower like the Reserve Bank wants? Right. My own read at the moment, it's probably going to go higher rather than lower.
We spoke the other day, didn't we? That the RBA came out and said we'd like to have lower interest rate. Sorry, we'd like to have a lower Australian dollar, and the Australian dollar promptly rose sort of 2 or 3 cents. So
yeah. Well, the old jawboning, it didn't quite work. Maybe they should try saying the opposite to try and drive it the other way, right?
Yeah. And I think you brought up this on our show. I'll put it back to you. Is that everyone's been playing this game for a lot longer than we have. Japan's been there for 20 years. Europe's been there for 10, and in the US, and so they've all been out there printing money trying to get the currency down. Australia's late to the game, and they need to do more if they want to get the currency lower.
Yes, well, they just sort of said that we've got plenty of ammunition in the locker, right? But you just wonder really how much they have. Now, one of the sort of the broader questions I guess ahead is how the economy is going to play out, right? And presumably you've got in your mind some sense of how you think this is going to work over the next 2 or 3 years. My sense is that we're going to see more money printing. We're going to see interest rates as low or lower than they are.
Yep.
We're probably going to see the stock markets still quite bubbly, if up and down, up and down, up and down. Particularly, of course, every time a virus, antidote or inoculation is actually announced, then the markets say whoopee and they'll go off again. But my question is, in this highly volatile environment, do you just sit there and sort of ride through it, or do you try and take advantage of the volatility?
Yeah, look, we think there's a bit of scope for the volatility, and I think that's probably your best bet of getting a return over the next sort of 5 to 10 years. Is actually making that assumption that, look, when markets are relatively high, it's time to be tipping out, and when markets are relatively low, it's time to be getting back in. I think we're certainly doing that within markets as well as within within the actual markets as well as within between bonds versus equities. I think you present your scenario analysis of different ways things can come out, and we do a very similar analysis ourselves in terms of road mapping and trying to work out what's the upside and downside in each case. So there might be times where we think, look, we're going to have a certain allocation, maybe a little bit more equities than what we might like, because we're worried about the downside, and we do think there's a scope to fall. And there'll be other times where we're comfortable as well getting a little bit more, and with the view that maybe we might take a little bit more protection on the bonds and then go a little bit longer on the equities, or vice versa. So to us, it's about trying to make all those different assets work together. We're not keen to trade and turn over our portfolio in large amounts, but having we sort of target trying to get about 30-odd%, less than 30% turnover in a year. And because we're in separately managed accounts, that can be quite tax effective, because we can, come the end of the year, we'll have a look at losses and what we can sell and offset gains. But I do want to say that over the last year, we've turned over more than that, and it's quite possible over the next few years, there might be a bit more going on, just in terms of as opportunities arise, we just need to be a bit more nimble than in the past of taking advantage of them.
Yeah. Very important, I guess. And then one other question which has come up several times, both on the chat and prior, the old inflation-deflation debate, right?
Yep.
In fact, I chatted with Steve Van Meter this morning, who's a macro analyst in the US, who's on the deflationary side. I spoke with Peter Schiff the other day, who's on the inflationary side. I'm talking to Harry Dent tomorrow. Guess which side of the equation he's going to be on. There is a real polarization out there, right? Which is I'm not well, I sort of have some theories about why it's polar, but what's your perspective on this inflation-deflation conundrum?
Yeah, sure. So I guess my take is very much that it's deflationary until proven otherwise. Is that there's been the arguments, and there's a list of extremely famous and qualified economists who all went to the Fed Ben Bernanke, when he started doing this massive amounts of money printing, and told him that hyperinflation was the thing, and it was all going to be his fault, and there's all these issues. People have been warning for a long time about inflation, and it will eventually come, because that's where but it will need changes to what we're doing at the moment. What we're doing at the moment, and the whole central banks get out and spend more money. Governments borrow a bit and do a bit, but they don't. They try and balance a bit, and they pull back, and we're worried about inflation getting out of control all the time. In that environment, I don't think we can see any sustained inflation for a long period of time. So I'm looking for a fundamental change, whether it be monetary policy, whether it be a proper clear out of debt jubilees, letting people go broke, whatever it is that needs to clear this debt, because with the amount of debt out there at the moment and the amount of inequality, I just can't see what will actually get out to cause inflation. And the inequality side, I could spend another whole podcast talking about, but the thumbnail sketch is, if I give Gina Reinhardt another $1,000, she's going to throw it on the pole and save it. If I give a homeless person in the street $1,000, they're going to rush out and spend it straight away. And so if you want to get demand and you want to get inflation going, you have less inequality. And if you've got more inequality, then you end up with these deflationary pressures. And there's no real sign that that inequality is reversing at any time soon.
Yeah, that's probably right. And, I tend to have the same view. If they continue to do the same as they've been doing, it'll probably be deflationary unless they break out and do something different. Then the question is, well, how does that happen, and when does it happen, timing and what have you?
Yeah, and you have to argue with the Senate setup. It's very hard to see that in the US Senate setup now. It's going to be hard to see that massive amounts of money being spent.
Now, what about the US election? Presumably Biden versus Trump. I'm not sure actually who's going to win. I mean, it's interesting. Very interesting bet that John Adams has placed. He thinks that Trump's going to actually be able to sort of claw it back. Other people say no. Is it going to make a difference, do you think, the result?
Well, look, the House and the Senate are divided. I mean, is he going to overthrow the House votes as well? I'm a bit more worried if that gets to the stage. So, I guess I'm more on the side that I don't think Trump's done at this stage. I think the Senate runoff is probably, well, actually, I don't really know. The Senate runoff, I'm not sure about. I think I'll put it down as 50-50. The vote was pretty close to 50-50. And I don't know if there's going to be a bunch of Trump supporters who don't turn up because Trump's no longer in the election, or if there's going to be a bunch turn up to teach the Liberals, that they should have the power in the Senate. So that part I'm not sure about. I think the danger from an inflation perspective, and when I say danger, it's in a very, very small font, because I don't think it is particularly dangerous. We really do need to see inflation. Was that Biden does a clean sweep and goes out and spends bucket loads of money. And I think that's off the table. So if Trump gets back in, then, we don't really know what he was going to do. Maybe some more tax cuts. Maybe does he mess up healthcare or not? Who knows? There's probably just a bit more of the same. So certainly business friendly. I'd prefer to be a business in the US rather than a worker in the US if Trump was president. It goes back a little bit more towards the worker under Biden. So, and that's a bit short-term, long-term, isn't it? So good to be a business in the short term, but if your workers aren't getting enough money and you're not getting enough demand, then the medium term looks pretty bad. So I sort of feel as if Biden is probably better for the market in the medium term, but maybe from a profitability perspective, Trump might be better in the short term.
I think both sides are going to be hobbled by whatever happens, right? So there's going to be contention, which means that some of the policy outliers probably won't happen, which means it's going to be slightly more centralist. But I
hope so. You hope that they do find ground in the middle to meet, rather than just being. I mean, maybe it just ends up being a bit of a nothing thing, that nothing gets done over most of the period because both sides are taking extremist positions and neither will budge. So.
Yeah. Well, it's been done before in the US. Now, we're sort of coming up towards the end of the show. Tim, there's one last question for you if you're still there, and it's a very simple question. What's the minimum to invest?
Yeah, sure thing, Martin. So our minimum in our technical range is $10,000. And what we've done is we've essentially put together a range of different ways that we build portfolios. It starts at 10,000, and then we get to our flagship range, which has about 100 or so holdings north of 200K. But at 10,000, you're sort of looking at ETFs, and then what we do is we trade out or swap out ETFs for direct equity exposure as the investable amount increases. So look, it's a good fit, and it obviously maintains a high level of diversification in the portfolios.
Right, and that's the point, isn't it? That you can start small and build if things go right. I mean, you don't have to commit everything on day one, as it were. No,
that's right. And look, so many of our investors, and indeed, I think anybody who is starting with a new wealth firm, or they're trying something out, a walk before you run approach, I think is warranted and makes perfect sense. Look, the great thing about these, and we've spoken a little bit about in the structure that we use, these separately managed accounts, is that they actually lend themselves to being able to make constant contributions or one-off contributions along the way, and the ability for them to actually group together brokerage. And we haven't spoken about this too much, but you're happy to get in touch, and I can go through this further with anyone who wants to hear me talk about it. But look, the platforms give a wealth of benefits by having direct share ownership that's beneficially and legally owned by the client. But of course, the brokerage issue, which is the big problem with holding individual shares, is minimised through them doing these book building processes. And you're looking at $1 to $2 an Aussie trade and $3 to $4 a direct international trade, which is pretty good in anyone's book, I think, Martin. Yeah.
Okay, thanks for that. And then just one last question from the stream. This maybe if you damn it, unemployment in Australia, right? The official number is probably north of the real number. Is that going to have a significant impact in terms of the local economy, and how are you reading the unemployment?
Yeah, look, absolutely going to have a difference. I think we tend to look at the underemployment, and I think the big factor we see, the most important factor we see that affecting is that coming back to that inflation, and that we're just not going to get wage growth of any meaningful amount until you can actually see that unemployment rate coming down. And it's starting to get competition for jobs, and that we actually start to need to pay higher amounts. I mean, the front page of the Australian on the weekend was talking about Scott Morrison had just wound all these public servants back, so they're only getting 1% wage growth, and then on the flip side, you turn around and the RBA's saying we need wage growth to get this going, and you say, well, the government just said it's not going to pay its people. And the private sector is not going to pay its people because they don't have to, because unemployment's so high. And so, that's one of those factors. Until you can start seeing unemployment come down to levels that it can actually see wages start to grow, then it's very hard to see a positive outlook for the economy.
Yeah, absolutely. Well, all the data that I'm seeing in my surveys suggests that real income is static, costs are rising. And the forward expectations from the SME sector is they won't be able to pay any increases at all. In fact, some SMEs are likely to fall over the next few months. So it's not looking very good. And it's sort of real world versus the RBA, view of the world. There's a big gap.
Yeah, that's right. And that's that we spoke at the start about it. It's good. It's a good place to finish. It's that real tension that we're sitting with those positives and negatives about saying, okay, if you keep backing if you keep trying to get all the bad things to go away by giving them more money or lending them more debt or letting them not go bankrupt for a longer period of time, then you can hold this together for another 6 months, 12 months, 18 months, whatever, before you really need to start running into these troubles. But if you do start seeing that they say, well, no, we are going to let people go bankrupt, or we're going to start enforcing some of these conditions, then you can see some things turning quite dire, relatively quickly if they let it get out of control the other way. And so the tension at the moment, it seems to be throwing more at the problem than what it warrants, and more than what I think it would warrant. But at the risk of moral hazard, but that certainly seems to be the way we're going.
Well, that's right. And of course, we've got the zombie firms trading insolvently. At some point, that will unwind. We've got the JobKeeper and JobSeeker winding off. We've got the principal interest repayment holidays coming to an end. my own view is all that's just going to get kicked on.
Yeah, and that's my fear. I think you're right. I'm treating it in the portfolio. That's the way we're treating it, and that's one thing we need to come back to. Is there's one part about saying, look, I don't want this thing to happen. I do think they need to start weaning off and actually taking some of these losses. But from an investment perspective, it seems pretty obvious that you're exactly right. If it can be delayed for longer, then it'll be delayed for longer. And if we can make it through the next election, that's all we really care about. And we'll worry about what the fallout is after that.
Yeah, well, I appreciate that. And thanks very much, guys, for tonight. I'm just going to play my little thing one more time because I can. Just to say that if you want to find out more, then there's a very simple way to go. Just go via Walk the World to walktheworld.com.au. From there, you can navigate through to the two different funds as well as to the DFA homepage and other things too. And that sort of is now my new, if you like, super homepage. So that's that. Now, I'll just come back to Damien and Tim. Any last thoughts from either of you?
You first, Tim?
Yeah, sure. So look, I guess we've spoken a little bit about the online onboarding and having a bit of a look at the opportunity that in the partnership we've put together with Walk the World Fund and Super. And so look, head over to walktheworld.nucleuswealth.com, which is the beginning login page for that. Of course, you can head to walktheworld.com.au and there's and guide your way through the various fund pages as well that we've put together. And yeah, going back to the portal, essentially, look, 10 to 15 minutes. It's all online. It's completely, paperless as well, which is quite handy. You can start and stop at any time. And importantly, there's absolutely no obligation to invest in using the portal. So if you want to go in and have a bit of a look, shows you the portfolios, does all the tailoring we've spoken about today, you're more than welcome to, or of course, reach out and always happy to have a chat. I've been chatting to quite a few of the viewership of the Walk the World group, and they've been a really, really enjoyable time over the last few days since we've launched. So I'm looking forward to plenty more. Please reach out and chat, and we can continue the conversation.
Yeah. Great. I've got a request for your listeners and viewers, actually. So there's two sides to this. One side's the investment side, the other side's the structuring side, and the whole idea that we want to give all this transparency and structures that we think are the most tax efficient and have custodians and all these other factors behind to sort of protect people's money. Is that if you see anything that you feel uncomfortable with or you don't think is best practice out there, we'd love to know about it, because we have tried to genuinely put something out there that we think the whole structure and factors behind it is something that's going to, this is a way most funds will look in 10, 15 years time, because it's what the high net worths want right now. And so, so it's the invite to say, look, we're trying to do this genuinely as an attempt to sort of bring more transparency and really help the financial industry sort of move forward. So we'd love to know about any problems you have or concerns, even if you don't want to invest, but you'd just like to let us know, what it would take and what you think we're doing wrong. Then we'd love to hear from you.
Yeah, thanks, Tim, and thanks, Damien. And the point about this is the human face of investing, right? What I wanted to stress today was that this isn't some big faceless entity that has a big brand but nothing much else, right? This is actually real people who actually care about what they're doing, which is one of the reasons why we've aligned, because we've got an alignment in terms of economics, we've got an alignment in terms of outcomes and intent, and the transparency thing is, I think, pretty important. So guys, thank you very much for spending the time with us tonight. Really appreciate it. I know you're a bit busy, but I think people have been very appreciative, and I think we've made it clear as to how people can pursue from this point if they'd like to follow up. I'm not going to do a big ongoing push through the community here. I think people have enough sense to understand that if it makes sense, they'll go pursue. But we will just from time to time just mention it in passing. And the idea is that perhaps we'll get you guys to come back and spend a bit more time in each month, perhaps thinking specifically about some of those economic questions and the macro questions and how it's beginning to shape what you're doing. So you're welcome to come back on the show down the track.
Thanks a lot.
Yeah, thanks, Martin. Yeah, really appreciate it. Cheers.
Great. Okay, so I'm going to just turn you guys off, and then I'll just close out the show. So just hold on. Right, so there we are, guys. Thank you very much for spending some time with us this evening. Appreciate all your comments in the chat. Been very interesting. Just to tell you that next week we will be, if I push the right button, we're going to switch tracks and talk about first-time buyers and the conundrum that they face. I've had so many people ask me about what first-time buyers should be thinking now, and I'm going to have a guest on the show who is very much an expert in advising first-time buyers. So I will leave the guest a mystery, but just to say that there will be a show next week specifically focused on first-time buyers. I also tell you that I've got some other live shows planned as we come up to the end of the year and starting to talk about what 2021 might look like. So hopefully that will also be worth pursuing. So mark your diary, 8 p.m. tomorrow. 8 p.m. next week, and it'll seem like tomorrow because the weeks just fly by. So there you go. Thanks very much for your time today. Have a good evening, and we'll see you next week. This is Martin North from Digital Finance Analytics, signing off.